you very much. I will be the sign that says session begin. Welcome, everybody. Will natural gas fuel the future? That is this panel. If you're looking for something else, you're in the wrong room, but the door's locked, so you're stuck. So you're going to learn something about natural gas, and I think we all will. Just came from a big energy panel, which is about energy scarcity, which is more general. So I think in this one, try to dig in a little more to the specifics. Maybe get into some of the other costs on the carbon side for natural gas, some of the externalities of it. Anyway, I've already talked enough. Ralph Eads, Vice Chairman of Jefferies, to the far right. Ralph, welcome. Good to see you. We've got Rick Grafton, CEO and Chief Investment Officer of Grafton Asset Management over here. Yossie, Hollander, Chairman of the Fuel Freedom Foundation, of which I think one of my former panelists just now, Jim Woolsey's on your board.
Correct.
Is that correct?
Correct.
I'm still not going to be nice to you, though.
I expected that.
Fantastic. Thank you. Shaia Hosseinzadeh, Principal of W&L Ross, Wilbur Ross, frequent guest on CNBC, smart guy, smart investor, but it's guys like Shaia that make him smart. And Nat Keohane, fantastic. Nathaniel, Vice President, International Climate Program, Environmental Defense Fund. So let's get started. And Nat, I actually do want to begin with you because we just finished up this big panel. We talked about the what was it? Boone corrected me. I think it was 2.38 thousand trillion proven reserves of oil, gas, coal in the United States. Trillion with a T, enough for 105 years if we just extract that and find nothing else. Pretty spectacular number. We talked about the opportunities. We did not go into necessarily the economic costs on the other side. Right. Is natural gas, fracking, shale, is that bad for America?
So I'm come from an Environmental Defense Fund. We're a pretty centrist, pragmatic group, and I also spent the last 2 years before these ones in the White House on the National Economic Council working on these things. So I think I start from the perspective that there's a huge number of benefits that we get from low-cost natural gas in this country. You talked about them in the last panel: energy security, jobs, economics, and so on. And from a climate point of view, there are potentially some big benefits too. Natural gas is pushing coal out of power generation, and that's explaining a big part of the decline in emissions. But if we're going to take advantage of that potential, if we're going to take advantage of this opportunity, we got to do two things. One is we got to have the regulatory structures in place so that we do it in a smart way, so that we extract natural gas, whether it's from shale or conventional sources, without polluting the groundwater, without polluting surface water, without polluting the air. And we know how to do this. Several states are leading the way. EDF is part of a group called the Center for Sustainable Shale Development, just got started. Chevron, Consol Energy are part of that. So there's partnerships growing around the country to say this is how we do it. This is how we do the standards. The second thing we need to do, we need to pay attention to the leaking of methane. Not something you can see, it's invisible, but methane is 72 times more potent as a greenhouse gas than carbon dioxide over 20 years. So if we don't get methane leaks under control, we could reverse the potential climate benefits from natural gas.
Doesn't methane leak naturally out of the Earth's crust anyway? How do we have any proof that this causes any more significant leakage of methane than the natural process?
Yeah, so I mean, natural gas systems, and the data is fuzzy. That's one of the problems we got to address. But natural gas systems in the U.S. are the largest source of methane emissions in the country. So we need to understand them better. We need to get them down. But again, there's a huge opportunity here. So if we do it right, and if we understand and cap the methane leakage, then we have enormous potential benefits for the climate as well as the economy and energy security.
Shaia, is it your fault methane's leaking out of the Earth's crust?
Look, I think there's the EPA. I think just last week came out with a new study on methane. And I think the initial findings were somewhat more in the favor of the producers, in the sense that they found that the leakages that previously were thought were not as high as one would have thought. At the end of the day, if natural gas is leaking into the sky, that's money that's going away as a producer that you wouldn't otherwise have in your profit pool. So I think the technologies that can be deployed to mitigate some of that are both achievable and practical, and I think there's an economic incentive for a lot of producers to put those in place.
It's an interesting point, Ralph, because, listen, producers would like there to be no regulations, no rules, no red tape. I got the land, I'm going to go down, I'm going to extract, I'm going to sell, I'm going to make a buck. Some people would argue maybe the administration was too far on the other side, too much regulation. What's the happy medium between the two things that makes it economic and investable, Ralph?
You know, I think the biggest thing the producers want is predictability.
I think one of the big challenges we face in the country is that the rules as between the states are different, and that's very challenging both for environmental community, it's challenging for the states, the level of sophistication among the states is quite different. So I think that the biggest thing that I think the industry actually doesn't really resist regulation. I think they just want practical regulation. And I think that, you know, one of the interesting points that I would agree with Nat on is that virtually every problem associated with natural gas development is solvable. It's just a question of how much are we willing to spend to solve it, right? And that's where we're not having a very good debate right now is what's the cost benefit, right? What does it cost to, I mean, we could probably cap virtually all fugitive emissions, but what does that cost, and is that a good trade? And that's where we're not having a thoughtful debate. I think probably the one thing that this all sort of points up is that a more thoughtful sort of energy policy for the country could produce an awful lot of benefit, and we're just not having that dialogue, sadly, but I think that that's one of the things, I think the industry would welcome it, as long as it's even-handed, and you know, you look at Chevron that's, you know, joined with Environmental Defense Fund to work on that. I think there's a lot of interest in the industry in having practical regulation.
You know, but we just heard from Josh Harris of Apollo, right, and they're obviously, he said the capital will be there to make these investments, right? So there's no shortage of people that want to get into this game, Ralph. So if it was too burdensome now, people wouldn't get into the game, right?
Well, see, what I think is that to the extent you add regulation, it just adds cost to the production, which at the end of the day is what is going to be borne by the consumer. And so I think the big issue is just predictability. I think the hard thing is you ask an oil and gas producer, okay, I'm going to make a 10, 20, 30-year investment decision, and I want to know what's the regulatory framework against which I'm investing. That's the key, is this predictability.
Let me just add one point on the cost. The International Energy Agency did a study called the Golden Age of Gas last year in which it looked at what it would take and what their estimate of what the cost would be. And as I recall, it would increase, if you did sort of everything right, you solved all the problems or all the potential issues associated with the externalities, it's a 7% bump up or something in cost. Now that's IEA's estimate. I'm sure other folks will have different views, but we're not talking huge costs here. I think we're talking a relatively small incremental one, and many producers are already doing that. So it's not, I don't think it's an onerous burden, but I think it's something, frankly, I think from the industry's perspective, it's something you need to do in order to make sure that we don't have a well blowout or some kind of an event that gives the whole industry a sort of a black eye.
Rick, give us the Canadian perspective on America and our natural gas policies. You don't have to be polite. We'll probably eventually go to war with Canada at some point anyway, so it's all right.
Yeah. We'll get there. I don't know how you're going to go to war because you're not going to have enough energy to run the war, and we do. But we'll
Although
start
90% of Canadians live within 100 miles of the U.S. border. Why is that? No, I'm kidding.
No, so let's talk about a couple of things that you started out on this fracking issue, and we were talking earlier. In the province of Alberta, we've been fracking wells for over 50 years. We are your largest supplier of gas. We're your largest supplier of oil. We have not had one incident on fracking, and if you get in, you can talk to 1,000 engineers, talk exactly how fracking happens. This is just a method that we frack wells below a rock that is impenetrable and significantly below the water table, and it does not seep into the water table. So we've never had any incidents, but we do a lot of it in Alberta. We drill thousands and thousands of wells, have for 50, 60 years. Now, you go to Pennsylvania, you go to New York, and someone fracks a well, and all of a sudden it's new to them. Their neighbors aren't comfortable with it, the farmers aren't comfortable with it, but we're very comfortable with it because we have a regulated industry. We were talking before we came on about Canada is 30 years ahead of the United States from an environmental point of view on how we treat from the well site to what we deal with the water and how we hook it up into the pipelines. So if you look at the Bakken play in North Dakota, and we have a lot of service companies that interact in both Canada and the US, and you actually drill a well in the Bakken and you put the groundwater, the water from the well back onto the ground. Well, we stopped doing that over a decade ago. In the province of Alberta, in the province of BC, they still do that. So we have tanks that handle the water. So environmentally, we have a regulated business. We are decades ahead of you environmentally. However, the U.S. Has significantly larger pools of capital, and this recent technology, recent horizontal wells, multi-stage fracs, have unlocked a great resource for the United States and for Canada. So I don't think the...
Let me ask you a little more bluntly. Do you think America is foolish in the way we handle energy policy?
Well, let's put it this way. You know, we have a regulator, and it's a provincial regulator, like a state regulator. And we have control of our own resources. And I feel bad for the Americas where they've got state and federal. So there have been, I'll bring up Keystone, there have been 15 pipelines that have been approved in the last 2 years that are going to export 4.4 million barrels of crude. You currently have 170 miles of pipelines that have flow 11 billion barrels every year, and all of a sudden you've got a federal government saying, we're going to look at Keystone and delay it for another 2 to 3 years. So foolish, I don't know, I think it's ridiculous. I mean, I don't see how you can have a federal group and a state group fighting over a state's resources.
Because now we can't fuel the future with gas unless we can get it to where the people are and build the distribution systems and the infrastructure, right? And that's where you're hot on. We have to get stuff to where it needs to go. So is this just America bashing by the Canadian, or is he right?
Well, I think if I want to stick to natural gas. I think that natural gas infrastructure is, and pipelines, I mean, largely that's a matter of private capital. But I know that's something when I was in the administration, we thought a lot about whether there were ways we could streamline that. It turns out, from a federal point of view, not a lot you can do. It has limited control over that. But from a policy point of view, it's really just let the markets build out that infrastructure in those pipelines. And we were, you know, the president put an executive order in for to accelerate and expedite infrastructure in terms of natural gas pipelines and so on in this country. So I think if you're, again, there's a limited amount you can do in the government side. Most of that's going to be private sector, and I think it's really a matter of figuring out where those investments need to be made to get the gas.
Okay, so Shaia, where are those investments that need to be made to get the gas?
I think we've gone from a period of resource constraint to resource abundance, and the bottlenecking today, particularly with wet gas and with oil, tends to be within the infrastructure and logistics space. Right. When you think about the amount of money that is going to be spent in the next 5 or so years, we're looking at something in the region of about $500 billion annually. And that splits out roughly 50-50 between pipelines, midstream, and upstream. The key challenge for, I think, investors to navigate is this structural lag that tends to occur in the energy markets. I think for people in this room who've been following the energy markets for some time, I think what history has shown pretty clearly is in periods where supply is increasing, the invariable reaction that the market has is to underestimate the extent by which supply grows. And that's led to crashes in commodity prices where they overshoot downwards. In periods where demand is growing, similarly, the market has tended to underestimate the amount by which demand grows, leading to similar overshooting on prices. And there's plenty of examples. You can go back to the 1920s boom in West Texas when oil was found. More recently, in the 2000s, we had the build-out of natural gas-fired electricity plants in the U.S. when the market was deregulated. And most recent of all, when Shale was discovered, natural gas went from $14 in MCF to less than $2 in April. So the real million-dollar questions for investors to navigate is with that kind of volatility, particularly for gas, when you're committing to 3, 4, 5-year capital formation cycles and you're putting that money in, how much certainty can you get on that rate of return? And it goes to the point that Ralph was making. People can invest in good environments. They can invest in bad environments. Businesses have a really hard time investing in uncertainty, particularly in regulatory uncertainty.
I just got off a panel where they said gas won't go above $4.50 or $5 for the next 10 years. Do you agree with that? These are some pretty smart folks that are on that panel.
Look, I think there's a healthy amount of debate around gas prices. I think somewhere between 450 and 6 is a reasonable parameter, but when you start threading the needle, is it 4, is it 550, I think it becomes a little bit of guesswork. What I can tell you is, if you were to map out the supply curve in the U.S., the marginal amount of gas has to come from dry gas. So 90% or 75 to 80% of our supply in the United States comes from dry gas. And the biggest two formations that are going to account for more than 50% of all the growth are the Marcellus in the Northeast and the Haynesville out in Texas, Louisiana. Those formations, but for maybe 10% that are the best of the best, are going to need between $5 and $6 to work. So if that's the marginal cost of bringing that gas to market, I don't think it's unreasonable to say that at $4.50, people are going to be a little bit strained to attract capital to grow that supply base.
So Brian, why don't we get to the point of what the panel was wanting to talk about, because I know there's some members of this panel, like, are we going to shift to natural gas, and natural gas is going to fuel our cars and everything like that? But if you look where we are today, and natural gas last year when we were here was $1.90, and it was uneconomic, and the panel, if we'd have been great weather forecasters, we'd have got it right, because we had an extremely warm summer, extremely cold winter, and natural gas, because of these weather-related issues, has bounced back in the early 4s. And coal switching, gas to coal switching occurred because gas was below $3.37. But natural gas is only going to be one part of a very complex energy system that we have, and it is not going to be the fuel of the future. Natural gas will be used in home, it'll be weather related, and even though I'm very bullish on the amount of natural gas that we have and the ability for manufacturing to start, for power generations to start, there's no signs that non-weather related demand has affected the price right now.
But if Yossie has anything to do with it, because when I was a kid, strapping young lad racing go-karts in California, we used a fuel called methanol. That actually powered my go-kart, and then I stopped racing go-karts, and I never heard about methanol again. I know we've all heard of ethanol. Now you're talking about methanol for cars.
I'm talking about any fuel for cars, not
so
just
tell
methanol.
us about this. What is it?
Ethanol, for example, just to give an idea, it can be
methanol?
produced. Yeah, but ethanol can be also produced from natural gas. Celanese is building a plant that will produce ethanol from natural gas at $1.50 a gallon. Is that a good price? Guys, $1.50 a gallon. That's their, look at the website. They're building it now. So methanol is $1.20. That's the market price right now. It's $1.20 a gallon.
Can you briefly, because methanol...
Could you put just for a second...
What is methanol?
Methanol is a liquid fuel made from natural gas, can be made from garbage, from anything.
You want
from
slide 36.
Slide 36.
We went from 0 to 36.
And this is the business opportunity, guys. This is where the money is, transitioning. Okay? So we've been growing our natural gas production. So the growth in 2011, can you keep clicking there a little bit?
It's got multiple stages. So
go
yeah,
all the way. So we increased our production by 1.7 billion MCF in 2011. In today's prices, that's about $7 billion worth. So that's how much the natural gas producers are getting. If we converted it, as an example, to methanol or many other fuels, methanol is just a very good example because all the race cars run on methanol or ethanol, so they probably know what they're doing. So if we did it and we replaced gasoline, we could have replaced $27 billion of gasoline. Okay, if our car could take it and we had a distribution system and everything. That's a pretty good money to be made between 7 and 27.
What would need to be done to run a current combustion engine on methanol?
Most of the cars built in the last 10 years probably can be converted to run on number of fuels for under $300 if it was legal. It's not.
And what would the distribution system be?
Not much, the same one. If you think
same
about
one as gasoline?
Yeah, because there are 160,000 stations in the United States. Okay, let's assume it's $100,000 to convert a gas station to also have methanol. It's the same tanks, it's just maybe a few rubbers. I give it 100,000, so you know somebody will make a lot of money in the middle. That's $16 billion. That's all, guys.
So what we heard in the last panel was we have this giant opportunity in natural gas but we don't have the distribution system. Now I'm hearing on this panel that we've got the distribution system, but we don't have the fuel, and if we did, it's illegal.
Right. But it's even
When's
more
the
than
cocktail panel?
Well,
Now I'm confused.
So we don't have the distribution system, and if you want to pull up slide 30,
Oh, you're dueling slides now.
dueling
So-
slides.
it's gonna be
I'm going to use a couple of Shaias too in a second, but you pull up slide 30.
your slides.
It just shows you how much fuel is used in transportation and LNG, and what percentage is
You
in.
want to share?
Is it? I'm sure it's 30.
You bring up 30, right, Rick?
I'm 30.
Okay, so there's 30.
Right there.
I can
So
see.
currently, transportation is 0.13 in vehicles right now. So 1.3. So let's say it expands 10 times and it gets over 1%. So right now in Canada, we have one filling station for gas, and there's 160,000 stations in the U.S., but there's not. It's to convert to that convert to 160,000 of them to liquid natural gas. It's not on. It's not.
But you don't need
Who said liquid
110,000.
I don't care if you got
liquid natural
50.
gas? But who said liquid natural gas? We said methanol. We produce methanol in the United States in volumes. It's the largest traded commodity after oil products. Okay, you can buy it. In everything you have here, there's methanol. There are methanol factories all over the U.S., everywhere, Louisiana, etc. We're actually bringing more of them now from abroad, disassembling them, bring them in here right now, so we can make it from natural gas, cheap natural gas.
Yes,
here. It's available.
Except, you just said it. It's illegal.
So let's make it legal.
Can I just
Why is
step back?
hold on, let's get more into this issue, because I've got a heroin-powered car idea that I'm going to come up with. Why is methanol illegal?
This is something I'll have to defer to somebody else on. I understand there's some issues associated with the ability, it's corrosiveness, right? But you have to deal with that.
It's got to do something bad, otherwise it wouldn't be legal.
No,
Explodes.
you can change your car regardless. Even if you want to run it on a better, if you want to add the gadget to your car that will improve your fuel consumption by 10%, it's illegal.
I know it runs because
you can do
I've
it.
run it in an engine
Right.
for years, but it was years ago.
When California did a test for 15 years, it was great. You ask any policeman, they had to give up the cars. They run on methanol, and they hated it because it was much better. But
Ralph, how many methanol investments is Jefferies making currently?
They'll be limited.
Limited to zero?
So yeah, one thing I would say is zero. That would be exactly zero. But one thing
Why?
I would say that's kind of an interesting, just a little bit of a sidebar that kind of relates to this whole conversation, is that you just don't underestimate the power of technology. And I'll just give you one little vignette on that one, which is we're helping a company raise money right now that has developed technology where they can burn natural gas and they can capture all the CO2. Which is very easy to dispose of. You can put it in an oil field and enhance oil production. And then you can produce electricity from natural gas with no emissions. And then you say, I can put that electricity in an automobile, no emissions. So you could have a vehicle system pretty easily with very conventional technology, right? They make Priuses off the assembly line today. It's not as efficient as methanol, right? You lose more BTUs because when you convert the natural gas to electricity. But anyway, the point being that I think that this whole debate about vehicles, I'm not sure the pathway it takes, but it's going to take a path because the fundamental reality is natural gas as an energy source is so much cheaper than gasoline. It's, that value proposition that Yossie puts up there. It's going to be captured somehow. I'm sort of a fan of saying, let's go electric. And
hold on, I want to follow up on that, Ralph, because we forget the first car ever built was electric, okay? But then we got combustion engines, and that was the cheapest molecule, and then we sort of built out our infrastructure that way. The Nissan Leaf is not selling well. The Chevy Volt, which is not even a pure electric car, right? It's not selling great. And outside of the Milken Conference, you don't see any Teslas.
Yeah.
Okay? Is there a Musk brother in here? But I want to make sure I watch out for that. Why not? Why hasn't this? Because GM built an EV, and Honda had one 20 years ago. There are a couple floating around the country still.
I think there's two things about that. They're expensive. And the other thing is range. It's the two. But you know, if you could wave a magic wand and solve the world's problem from an energy point of view, there's one thing: it's batteries. Batteries. You know, if you could get better battery technology, but eventually, I mean, I think just progress incrementally in battery technology is going to make electric cars win, in my view. And you know, I don't know how long that takes, but you know, it seems likely to me that electric is a very clear pathway. I don't know, maybe methanol is better, but you know, the hurdle with methanol or LNG cars or compressed natural gas, any of these technologies, is there's a lot of hurdles to making that work at scale.
But you're investing in Jefferies in that vertical.
I'll tell you, the place we've been more active is in what I would call industrial applications, okay? Trains, over-the-road trucks. Those are the places that seem more likely to be early adopters. And there's two reasons for that. One, they don't need the same sort of level of distribution network, right? Because, you know, an over-the-road truck or a train in particular, they fuel at the same places every day. And the other thing is those people get two benefits. They get price, right? Because the fuel is much cheaper than gasoline or diesel. But the other thing is those people care about, as organizations, their environmental footprint. So if you're Walmart and you say, well, wait a minute, I can, you know, adopt over-the-road trucking for distribution of my goods, and I can cut my carbon footprint by 40%, which is the number for Walmart, that's pretty compelling.
I think UPS just made a big...
Yeah, UPS is going to do it. FedEx is going to do it in my view.
their trucks.
Yeah.
And they can also go 700 miles between filling up.
So Brian, what do you think, if you think of energy as a global business and not a North American or American business, what do you think the Chinese are going to be using? What do you think Asia is going to be using? What do you think India is going to be using in their cars? And they are fueling it with oil.
They're fusing it with methanol. In 2 provinces in China, more than 50% of the fuel is from methanol, by the way, from coal. So they made a decision in those 2 provinces because they got local coal and it's cheap. It's 50 cents a gallon to produce.
They're not putting coal in
No,
the
they're converting coal to methanol. Okay, and they're putting in the car. More than 50% of their local provinces, those provinces, each one local, is 30, 40, 50 million people. Yeah, it's a small
can I just
province,
maybe
okay?
step
Jump
back,
on in here.
just step
Help me
back
out.
for a second? I want to react to 2 things that was said. I think the transportation discussion is a very interesting one, and I think it's worth pursuing for the U.S. as a whole. But if you're really focusing on natural gas for pure emissions, 20 to 30% of the coal plants in this country are responsible for the highest levels of mercury, nitrous oxide, and SOx. So from a pure footprint standpoint, that's sort of the ground zero. Second thing is, there are 3 reasons really, I think, why you would want to transition to natural gas. The first is national security, so less dependence on foreign oil. The second is it's more economical. And the third is that it's cleaner. So if you sort of think about that and then think about the pie chart that I think Rick might still have up there, I'm having a hard time seeing it. I guess it's not the one, but yeah. So electric power, really, and industrial and commercial are what's going to drive both the biggest impact on carbon footprint and environmental footprint, as well as gas demand going forward. And if you flip to chart 23 real quick. Can we get
I want maybe to put slide number 46.
Hold on, Shaia. You got to your slide requesting was first, so he trumped you on the slide. That's next.
I think the penetration story, at least from my point of view, is best told by this chart. And you see
which number is that, so we can see it down here on the.
This is slide 23.
23.
And so what you can see, what this chart is showing is the relative penetration of the 3 fossil fuels in the United States going back to the 1980s. And so the red line there is coal, and the dark brown is oil, and then gas is the blue. I think the salient point, and this is really important, I think, to contextualize, is we've seen what is really a little bit of a secular step change going forward in the usage of gas for power. In 2006, where shale production really took off and prices came down, we've seen the utilization rate on gas plants go from the 30s to the 60s. Now, that's the first phase. We think the second phase of demand creation is we're going to see the retirement of somewhere between 20 and call it 60 gigawatts of coal-fired capacity. And really, there's very few, if anybody, building a coal plant in the U.S. It costs twice as much to build per kilowatt, and it takes 3 years to build if you can get the permits. And I think when you think about things that are going to have the most impact in this country whether it's environmental or economic, I think that's the ground zero right there.
Okay, so
can I jump in on that, because I know Yossie's going to take us off back to methanol. So on the power, I think Shaia is exactly right that the real story in terms of natural gas, or one of the major stories, transportation. That's kind of, people look at that because oil, that's such a dominant part of our fossil fuel mix. But where natural gas is already making inroads is in power, and will continue to do so. I think, and Shaia put it well. The next stage is new build, and we're not going to see any coal plants built in this country anymore. And I think
new build of what?
New build of power.
Because we're trying to find investment opportunities as well.
Right.
So what is going to be built? Where's the $2 trillion of capital we just talked about in the last panel over the next 20 years going to go?
I think the main question from an investor point of view in terms of natural gas for power is the load, is the growth of electricity demand rather than competition from coal, right? I mean, natural gas is going to be the base load power generation technology, and the question is, how much does electricity demand grow? I think that goes back a little bit to one of Ralph's points about electric vehicles. If you think about transportation, if you electrify the transportation fleet, or if you think that's where it's headed, that provides an enormous opportunity as well for natural gas, but through the electric power fleet rather than directly through liquid fuels.
Yeah, if a car could go more than a couple hundred miles, I mean, I'm not.
That gets back to the batteries.
I'm not running out of fuel in the New Jersey or energy on the New Jersey Turnpike. I won't purchase the car because I'm nervous about the range rate.
So what Shaia is saying
we're not there
is
yet.
gas is going to be used in residential, it's going to be used in industrial, and transportation is not going to be a major component.
It's the only one, actually. So if we could just show the draft, I actually want to use your slide. I'm sorry.
Which slide?
Your slide, the last one. Yeah, the last one at 23. I'll start from it. Do you notice?
Slide 23, please.
23.
It'll go.
We'll notice in that slide, basically, you're looking at our energy consumption in terms of energy. Who cares? I'm sorry, you're not using energy. You're paying dollars out of your own pocket. Okay? So basically, we've seen that the percentage of energy from gas is higher. So what? Does it tell you how much you spent on it? No. Can you go to price to slide 35 now? We need to stop talking about energy. There's no such a thing as energy. None of you ever paid an energy bill. You paid a gasoline bill, okay, at the pump. You paid a natural gas bill for heating. You paid electricity bill. You never paid an energy bill in your life. So if you look at this, let's look at the energy bill, the actual numbers we spend in the United States. And 82%, okay, of our national fuel expense, which is in the 90s, was $780 billion, okay, in 2011, was on oil. And almost all of it is transportation. Okay, so that's the numbers. If you run your business on the other 18% and have a discussion even on the 18% instead of the 18%, or the 82% on here, all those businesses here will be bankrupt. You got to run it on the 82% and stop talking about the 18%. Our country, by the way, is bankrupt, okay, if you haven't noticed, because we're talking about the 18%. By the way, coal, 35 billion. Big deal. Okay? Pollution, greenhouse gases, oil is number one, not coal, oil for the last 7 years.
That's not true in this country.
It is.
It's not true.
Are you including automobile emissions in that? Then it would be through automobile emissions.
It is the data, and we can show it. It's a study by National Science Foundation. So you have to either you say they're lying or they're not lying. That's what I'm going to offer. It's the largest. Just again, it's not electricity. You confuse electricity. I'm saying coal is larger than oil is larger than coal. Oil is larger than natural gas. Electricity is still larger than transportation. Two different things. I said oil is the largest source, okay? Now, if you're talking about what we need to replace, therefore we need to stop talking about electricity just because we need to run our business like a business is run on the 82%, okay? And stop talking about the rest. Now, you ask me if we can make money if electric car is going to transfer it to the, we're not talking about, the key issue in natural gas prices is not what's going to raise them up in the next decades if we want to raise the demand and you want to raise supply and have a lot of investment. Where will that natural gas go? It takes a long time to build gas turbine. The reason it replaced coal in the last year or two, because we had spare capacity of natural gas, of turbines sitting idle. So all the management of the electric company had to do is to switch. Okay, turn this one off and this one on. But now we got to build more. That's going to take a long time. LNG terminal, very long time. Converting your current car tomorrow. And that's the big difference. And building those infrastructure can be much faster.
But
now,
you can't be saying that building the infrastructure to distribute methanol as to compete with liquid.
Tanker?
But no, to compete with methanol in terms of service stations around the country, you can't say that that's quicker to do than to build.
So you mentioned a company like Walmart, okay? So Walmart's share price is inversely related to the price of gasoline, right? Both the people who buy that, okay, they lose about $4,000, $5,000 a year out of their pocket driving car more expensive. Walmart today offers 10 cents a gallon, 20 cents a gallon less in their gas stations. There people are standing in line over the weekend for 1 hour to fill it up. What if they offered $2 a gallon before taxes, $1 cheaper from ethanol? And your car could take it. They can offer also the conversion service if it was legal.
I hear what you're saying.
How long do you think it's going to take them to do it?
I hear what you're saying, okay, and you've made a very compelling and strong case for methanol. But you're going to forgive me for this because you sort of come out of left field with this whole thing. Like, I mean, if this was the greatest, you're making it sound like the greatest thing that's ever happened to U.S. transportation fuel policy. But where has it been?
It's been a lot.
You're obviously a smart guy. But it's not like somebody says, "Oh shit, methanol."
Look, people did it in
That's
California.
the answer. Sorry
people
for the bad language.
No, people did it in California. Okay, it got killed. If you do the experiment,
Why?
It got killed because at that time oil was $20, $30 a gallon, and the natural gas went to 14, etc. So now we've got in a reverse. Oil is at 100, okay, and natural gas is way lower at the 4.6. So what happened is a transition in supply, demand, and prices. Okay, that's a whole different issue. So it got killed here largely on price.
So, Brian, I think Shaia and Ralph will agree. We invest in energy companies, and the energy companies that we invest in look for the highest IRRs on the projects that they drill. And currently, they look for liquid-rich natural gas plays because they have the highest rate of returns, or they look for light oil plays like the Bakken. So from an investor's point of view, and maybe one day I'm going to be driving a Tulsa or something, but from the investor's point of view, what oil companies look for is projects with the highest IRRs. And currently, the highest IRRs are coming for liquid-rich plays that happen to be in the Eagle Ford, they happen to be in the Marcellus. That's where the dollars that you're talking about are going to go into for the next decade. You know, and that's where the capital is going to go because that's where you get the highest rate of return.
I'm going to ask you then, Rick, because we just talked about this in the last panel. If there's some people that were in the last panel, you forgive me for asking the same question twice, which is, is it too hungry? And maybe Ralph could address this as well. Are people overpaying right now? I've heard some people I've talked to that I believe and trust say, you know, it's a little crazy. Some of the shale plays have gotten a little bit crazy. When you look at sort of what companies are valuing these plays on their balance sheet at, I'm not going to go into company names, it seems like they're overvaluing it. Some of the prices have been overdone. Is there any way there's any kind of a bubble here?
What you always have to, when you look at a company, you've got to look at the assets they have and how bright the future looks. And you have to decide how much you're going to pay for that bright future. And I think there are some companies that tend to get ahead of themselves, but there are a lot of companies in Canada and in the United States that are growing at greater than 40% on their cash flow, on their productions, and their EBITDA. And if you can do that, and they've got a good balance sheet, that's where you want to focus on.
Ralph, is there a shale bubble?
No, my perspective will be the opposite. I think that if you just sort of look at the public companies as a group, they're very cheap relative to their intrinsic value.
Talking about natural gas producers?
Yeah, natural gas producers. And but another thing that this is a whole different curveball in this whole discussion, but when we're talking about the natural gas future, one of the things that's not getting a lot of discussion that's very important today is that the industry, the oil and gas industry in North America is struggling with their ability to actually drill all these wells. And what we've done is the oil and gas industry, you know, it's like saying I've got a construction company that knows how to build skyscrapers, and now I'm going to ask them to build mobile homes, and lots of them. Because we've really made a massive transition for what we're asking this industry to do. And the consequences of that is there's been a lot of disruption. And I'll give you just two sort of statistics on that. Of the 40 largest independent E&P companies in North America, 40% of those companies are in the process of CEO change. just name another industry of size where you have 40% of the companies in midst of basic management change. And that's a function of the fact that a lot of these companies have failed to adapt to this new world, and they've woken up and disappointed their investors, disappointed their boards of directors. So one of the other challenges, and one of the reasons that natural gas prices may be much higher than we all think, is the inability of the companies to actually drill the wells. The process of drilling large-scale shale development is very complex, and when we overlay greater environmental regulation, which I think is appropriate and coming, it adds even greater complexity. And this is not well understood, but the one thing I would tell you is I've seen an awful lot of large-scale projects, and the one thing I can consistently tell you about them is that the operators of those projects have been unable to drill the numbers of wells they projected when they began the projects. So one of the biggest things that I think is not being talked about now is that the industry has done a not great job so far of adapting to this new world, and that in turn affects the issue of, is the gas going to come out of the ground in a timely manner?
Let me push back just a little bit, Ralph, because 15 years ago, if I was a utility CEO,
yeah,
and a boring old utility, and I didn't become a fiber optic play, right, and watch my valuation triple, I was booted from the company. Every utility company, even every railroad, some of the most boring, stable businesses tried to become fiber optic companies. And if you didn't, you were dead. Then we realized, whoops, you lost your core mission, you overreached, you should have been the smart guy that held back.
Right.
Is there any chance that the industry is overreaching here and that will look foolish 5 or 10 years from now?
I don't think so. This is just paradigm shift, right? It's because
is it long enough of a paradigm shift that these reinvestments make sense?
Yeah, and it's just that the companies are having to adapt because to use your analogy, the conventional business, right, is a dinosaur. And the new business is clearly, because just the economics are so radically different. In the conventional world, you can find natural gas for $2.50 a thousand, and in shale world you can find it for 50 cents. I mean, it's so radically different, and it's and the problem is the process of actually producing the gas is different. And people think it's the same, but it's actually quite different for a lot of reasons I could go into. But and so the industry is having a very difficult time, much more difficult than people realize, adapting to the new world.
So if you took the top 10 U.S. gas producers, the top 10, and you looked at their guidance they've given the market right now, their production's going to decline between 2 to 10%. So if that's the top 10 and that's what they're declining, I'm not sure how we're going to get a massive...
Why are they declining?
We're missing
because
a lot of
the one thing that always happens when you find a gas well, as soon as it starts, the reserves start declining. And the new reserves decline by greater than a new well, unconventional well declines by greater than 50%.
I'm going to jump in here and maybe let Luke finish and then I'll jump in.
So we're finding gas, it declines after that, and then it's a cost benefit analysis. And are you going to make enough IRR on this one project to do it? And what Ralph's saying is true. The industry is, the old industry is finding it more difficult to offset these declines. And then when you look at
by the old industry, old versus what?
BP,
What would be the new natural gas industry, though?
Smaller companies like a Range Resources,
More
like
nimble.
Bonanza Creek, absolutely. And they don't have the built-in infrastructure that some of the older ones
Then
do.
why would Exxon spend $44 billion on XTO?
That's a very interesting question. I was on the other side of that trade. I know the answer to that question.
I didn't even know that.
They bought that company because they thought they were buying the expertise to drill the wells at scale. That's what they thought. They were buying a perfectly good set of assets, but they said, we, Exxon, know how to build skyscrapers, and we need to buy the ability to build mobile homes. And that's why they did it. Yeah. The interesting statistic, if you look at the number of wells, that the number of drilling rigs that the two companies, XTO and Exxon, were drilling were operating onshore in the U.S. at the time of the merger, it's more than they're operating today. So it's a very interesting thing. I think it was probably a good strategy by Exxon. It'll probably work out, but it has not been a panacea. And the other companies, I mean, so you take Chevron, great company, but Chevron's operating onshore in the U.S. 30 drilling rigs, right? Appropriate for their asset base is more like 100. So the issue they're wrestling with is how do we get to 100? And there's only been one company, and that's operated more than 100 drilling rigs onshore in the U.S., and that company's in retreat. So it's a very interesting problem. And so one of the things that bears on this debate of will natural gas fuel the future is, can the industry produce the gas? I mean, the resource is there, but it's different to say it's in the ground than I can produce it.
You asked a question earlier that I thought was an interesting question, and you asked if there's a bubble in shale. I think it's really important to contextualize where we've been to sort of understand the investment opportunity set and really answer that. We came out of 06 to sort of 2011, and it was a gold rush for shale. People were getting money thrown at them by Asian buyers. The folks in this room that were in the public equity markets were providing a good deal of share capital. There was a lot of financing available. And what that led to, and there are several examples of this, where people just went on a binge and bought all these lease positions that they had to drill, and if they were not drilled, they would lose them. And so I think the first phase in the shale paradigm was about unprofitable supply growth. And then what happened is we saw a warm winter and gas prices collapsed. And if gas prices are an indicator, it was the worst time in the industry for a decade. Where we are today is the industry has come out of a very difficult period. During that time, a lot of the producers have either divested their assets on the dry gas side, or they've redirected human and financial capital towards oil assets. And I think that's a really important thing to take into account, because as gas prices come back up, and they have been, people are not going to reallocate those resources on the switch of a dime. You asked about 455. I think for people who are out there that have been communicating stories to analysts, who've been talking to their boards about capital budgets, for them to go back and reset their corporate strategy back to going to dry gas, I think you're going to have to see gas prices in excess of $5. Now, coming back to the sort of shale bubble, I think if you're sitting in the seat of a value investor with a patient long-term capital profile, I think this is a really unique industry, because this industry overshoots. Supply and demand move in 3-year lags. We've gone from a period of unprofitable supply growth. As Rick said, we saw January EIA data showing an actual decline in gas production. And so you're buying into a period where gas prices are going up, supply is coming down, and demand, for a lot of secular reasons, is starting to increase, because the capital formation cycle there is 3 years, 4 years for these big projects to get built. So if you're sitting from the point of view of an investor, I think it's a pretty interesting time to be looking at both the upstream space and also logistics. I mean, we've looked at a number of different plays. We've invested in the LPG sector. We're generating more LPG byproduct as a result of these liquid plays.
Like how have you guys invested in that sector? Like,
we basically,
be a little more specific.
We acquired the world's largest liquid petroleum gas shipper of products out of the U.S. It was a transaction where we helped them build the largest fleet through an acquisition. And then we acquired a majority position through the Lehman estate. And the company today is the largest shipper of the products, the byproducts of liquid gas that come out. And they go into emerging markets. LPG is used in emerging markets for heating and for cooking. And it's a secular trend of a 7% demand growth market on the demand side. And on the supply side, you have the sustained amount of growth of very cheap, very cost-competitive long-term supply. So there's a lot of different pockets of capital. I think fundamentally, if you can understand these tectonic shifts between supply and demand, there's a lot of pockets where you could potentially put money to work. And I go back to this $500 billion a year. That's a lot of capital to fill, and the rates of return attached to that for people who can be well-placed are going to be very attractive for years to come.
I want to relate actually to that, because most people, you heard the previous panel that you chaired, said, oh, we're going to be energy independent by 2020, we're going to start exporting. If you ask me what I'm worried about, it's not our ability to convert cars or convert gas stations, it's our ability to produce gas, because I know what's happening in the drilling sector. Okay, I'm also in that business too. So there's not enough capacity, both financing, etc., to generate all those promises of how much we're going to have on the ground and actually lift it out in the next 10 years. If we start converting our cars, we actually, and do it in a massive scale, we're going to have a shortage of natural gas. Prices are going to go up. There's not going to be enough. It's going to take a while until more capital and more drills are going to get built, etc. And it's not, how many companies build drills? They're not increasing their capital investment right now.
Is it capital and time constraints, or is it other things with it all in? You know, sort of maybe you could address this sort of the overall regulatory scheme. Do you guys feel the market wants to move too fast sometimes? What's an appropriate speed of development?
You know, I mean,
from the EDF's point of view.
I certainly haven't seen any evidence. I talked earlier about the relatively small incremental costs. I don't think that, you know, the overlay of environmental regulation or the threat of environmental regulation it has a serious shadow on this. I think the fundamental issues that people are talking about is drilling rigs and where you move them, and the relationship of you know, oil prices and natural gas prices, and decision to go to wet plays or dry plays. I can't imagine, maybe someone will say otherwise, I can't imagine that environmental regulation is the first thing on people's minds when they're thinking about these opportunities.
CEO, I mean, CEOs tend to whine a lot on you know, certain television shows and whatever. I mean, I don't know, is it whining? Are they just...
I mean, but I think at the end of the day, there's, you know, as we said in the beginning, we know how to deal with the environmental impacts, and many states are already, you know, putting those regulations into place, and the additional ones are not going to be that burdensome. So, you know, maybe there's a period of a little bit of unpredictability, but I can't believe that that's driving major capital decisions over the supply.
It does it to the guys who build drills. Because they don't know if how much fracking is going to be. So they say, how much are we going to overbuild building capacity, and then 5 years later they're going to shut it down by some EPA regulation? That worries them a lot.
Yeah, it's a little more complicated than that. I mean, I'll give you an example, you know, which is, you know, for an example, in Pennsylvania, there's some concern that there could be water, you know, they don't have any natural disposals, aquifers for frack water in Pennsylvania, so you have to truck it to Ohio, and that's very expensive. But, you know, if the state of Pennsylvania were to take a really hard line in terms of disposal of frack water, which I think could be appropriate from an environmental point of view, that's like a showstopper. I mean, it's not a money thing, it's a I can't do it thing. Right? So then you ask yourself, okay, am I going to go spend, you know, billions of dollars acquiring the right to drill if I don't know whether I can drill or not? So it's a little bit binary. I mean, it's what happened in New York, right? So in New York State, they banned drilling and fracking. It's probably appropriate in my view, actually. But for people that spent money acquiring the rights to drill, right, they've lost billions of dollars because of the, you know, so some of the regulations binary. So it may be low probability that it, you know, shuts down drilling, but it does have the effect. And the industry is a little bit, you know, chastened by the fact that, you know, the experience of ANWR, for an example, the experience offshore California, you know, where there have been places where they've been shut down. So the industry tends to be a little gun shy.
But you made an interesting sort of just off the cuff remark a few questions ago, Ralph, where you said more regulation, and I think it's coming.
Oh, it's definitely coming. And my point is the industry just needs certainty. I'm with you. I think you're exactly right. I think prudent regulation is not going to be that expensive, and I think it's good for the industry, good for the environment, and everybody wins. We just need to get it done. Yeah,
should be in favor of almost more regulation as long as there was some stability of regulation.
Exactly. That's my point. I mean, I'd rather have.
Why don't we have that? That's a good point.
Well, I mean, I think that's what
being lost?
We will. I think you've had a history or a period of time where the debate's been, and it continues to be, very polarized. And I think the challenge is finding some middle ground so that people can say, all right, here's a set of reasonable standards, here's a set of reasonable regulations. I mean, that's what the center I mentioned earlier is trying to do. Here's a set of reasonable approaches that the environmental community can agree on, and the regulated community, the natural gas community can agree on, and then let's just move forward and put them into place. Because I think we would agree sooner rather than later. You need to get those regulations in place, and once you get them right, you don't need to screw around with them.
Have you and Wilbur, Ross, ever sat in a room and said, "Gosh, man, the numbers look fantastic. Look at it," but we don't know what's going to happen with regulation. We don't know what the scheme's going to be down the road.
Look, producing energy is an industry like any other heavy industry that has an externality. If you're gonna drill a well offshore, there's a risk that Macondo happens. If you're going to nuclear plant, there's a risk that there's a meltdown. But I think on a relative basis, natural gas has the lowest externality when you have incidents go wrong. I mean, we've all sort of seen the documentaries where somebody's tap light's on fire or things like that. But think about, and we talked about this earlier, but think about the biggest two problems with natural gas. The first is potential leakage into the aquifer. On average, there's about 17 Empire State Buildings between where you drill for gas and where the aquifers are. And there's solid rock between them, okay? So where the accidents happen is really operators cutting corners, where they're putting the casings of the well, instead of reinforcing them, they're cutting corners. This is a $200,000 expense to fix. And we're talking about wells that can run from $8 to $10 million. So these are not going to change the fundamental economics of those projects. The second is how you treat disposal water. And you look at people like Range Resources, and you look at some of the larger operators, there is a developing industry best practices where people are recycling. And so a lot of the problems that you've seen tend to be isolated, but they get a lot of press. So on a relative basis, I think it's just something that would be addressed with greater regulation, and the best practices of the larger players become more homogenized downstream with the smaller guys.
Great answer, but let me ask it again. Are there industries that you will not invest in because of the fear of environmental or regulatory schemes changing, or whatever? Or the things you just avoid at all costs?
I would say there are a handful of industries where we're much more wary of the regulatory elements. So I'll give you one example. In the U.S., there's a subsegment of the shipping sector called the Jones Act tankers.
Yep.
And it costs the U.S. roughly 2 times as much per tanker to build the same ship that somebody in Korea will build. And the only reason that industry is in operation today is because there's legislation that's many years old that says if you are going to ship crude on U.S. waters, it has to be a U.S.-built ship, U.S. flag, U.S. crew, and U.S. owned. Now, there are a lot of people who buy those ships for twice the cost of what other people build them for outside the U.S. If that legislation changes, overnight the value of that ship falls. So we tend to avoid those types of binary idiosyncratic risks.
Let me put one thing on the. Let me put one thing on. Yeah, so that's what I was actually just going to say, which is we've been talking about regulations on extraction of natural gas and local air and water regulations. I think the big regulatory driver, which more I think is an upside for natural gas in the near term, is a price on carbon, and we're not going to get that in the next couple of years, but I think eventually that's coming. And if you put a price on carbon, the thing that takes the biggest hit right away is coal. Now, in the long term, if you get the price on carbon that I think we need to protect the climate and protect the planet, well, you need to be driving it up, probably starting at about $25 and increasing it 5% a year. So by 2030, 2040, 2050, that price has climbed somewhat. And so in the long run, that starts to weigh on natural gas. But in the short run, a price on carbon really hits coal, and I think emphasize and reinforces this upside for natural gas in terms of the short run advantage it has over coal on greenhouse gas emissions.
It's amazing. We got to wrap up in a minute or so, but I mean, we've just had 2 panels. I mean, I don't know if anybody here was in the other panel or not. And we know the data. It's so huge. These numbers are gigantic, right? And America's now the Saudi Arabia of natural gas. We've got all this stuff, and you're agreeing. I mean, you're at the EDF, and you're saying, listen, we'll do it, but we're going to do it the right way. I mean, what are we missing here? I feel like there's something. It's almost everybody's too bullish on this. There's too much optimism. Am I missing something with this industry? Is it literally that much of a revolution in the last 5 years or 10 years with the technological changes?
I had some fancy slides ready to go in the beginning, but we're out of time. I would just
throw up your fanciest.
Okay. How much time do you have?
3 minutes. 2
Okay.
minutes.
Page 20.
1 minute. Okay, thank you. Boy,
1 minute.
That's time deflation rapidly right there, wasn't it? That's a 3, 2, 1.
Look, I'll just leave you with this thought. Slide 20, if we can pull it up. In my view, when you think about shale, it's a disruptive technology. The only other industry that I could think of in the last 20 or 30 years that has had a transformation as a result of a disruptive technology is the internet to the tech industry. And I think the shale industry will be as important to the energy industry as the internet was for tech, with the exception that the benefits of shale for the foreseeable future are going to primarily reside at home in the United States and North America, for the reason that we're much farther ahead in the development of shale than any other country in the world. And frankly, just like the internet revolution changed the way that not only how we produce content, but how we consume it, we believe that in the next 4 to 5 years, the shale revolution is going to evolve into how we consume natural gas and other forms of energy in the U.S.
That was an excellent analogy. I remember you mentioned that to me, and I totally forgot. Thank you for getting that in. And it's interesting, too, because the man that invented the internet, Al Gore, is signing books tonight in the Associates Lounge. What does that have to do with anything? I have no idea. It's been a long day. Thanks to all of our panelists. Thank you all very much for coming. I thought it was a good discussion. Take care, guys. Thank you.